crypto investments during bearish times? Not a chance. Because, my friends, this is where the real opportunities are forged. This is where the smart money is made. Today, we're not just going to survive the bear market. We're going to thrive in it. We'll explore the best crypto investment strategies for these trying times, comparing the active trader's game of range trading with the passive investor's pursuit of yield farming and liquidity provision. We'll look at what the experts are saying, what the big institutions are doing, and most importantly, what you can do right now to position yourself for success. So grab your notebooks and a warm beverage because class is in session. Before we dive into strategies, let's get a clear picture of the battlefield. As of mid-November 2025, the crypto market is a very different beast from the raging bull of yesteryear. The total crypto market cap, which once flirted with astronomical figures, has shed over $1 trillion from its peak. Bitcoin, our beloved digital gold, is currently trading below $95,000, a level we haven't seen in 6 months, and a far cry from its all-time high of over $126,000. That's more than a 20% drop, officially plunging us into bear market territory. And it's not just Bitcoin feeling the chill. Ethereum, the queen of smart contracts, is also down, trading at around $3,150. We've seen massive liquidations, with a staggering $19 billion wiped out on a single day. In October, the derivatives market tells a similar story. According to CoinGlass, we're seeing a 24-hour trading volume of over $300 billion, but with a significant number of liquidations totaling over $665 million in just one day. The long-short ratio is hovering around 48% to 52%, indicating a slight bearish sentiment among traders. Now, I know these numbers can be disheartening, but as the old trading adage goes, the trend is your friend, and right now, the trend is sideways. This is not a market for blind hodling or chasing parabolic pumps. This is a market for strategy, for precision, and for a healthy dose of intellectual rigor. So, let's put on our thinking caps and explore how to play this new game. For our active traders out there, the ones who thrive on the daily dance of the charts, the current market conditions are a gift. Why? Because we're in a range-bound market. Imagine a tennis match. The ball is being hit back and forth between two players, staying within the confines of the court. In a range-bound market, the price of an asset, let's say Bitcoin, is bouncing between a clear level of support, the floor, and a clear level of resistance, the ceiling. Our job as range traders is to buy at the support and sell at the resistance. It's a simple concept, but as with all things in crypto, the devil is in the details. So how do we do it? First, we need to identify the range. We look for a period of sideways price action, where the price has tested the support and resistance levels multiple times. Think of it as the market drawing a box around the price. Once we've identified this box, we wait for the price to approach one of the boundaries. When the price hits the support level, we look for confirmation before buying. This could be a bullish candlestick pattern, an increase in volume, or an oversold reading on an indicator like the Relative Strength Index, RSI. We're not just blindly buying at the support. We're waiting for the market to tell us that the support is likely to hold. Once we're in the trade, we set our target at the resistance level. And most importantly, we set a stop loss just below the support level. This is our safety net. If the price breaks down through the support, we're out of the trade with a small manageable loss. Remember, in this game, capital preservation is paramount. We're not looking for home runs. We're looking for consistent base hits. A successful range trade might net you a 2 to 5% profit. But with a tight stop loss, your risk is limited to 1 to 2%. It's a game of probabilities. And in a range-bound market, the probabilities are in our favor. Now, you might be thinking, Bonnie, what if the price breaks out of the range? That's a great question, and it brings us to the risks of range trading. The biggest risk is a breakout. This is when the price smashes through the resistance or plummets through the support, starting a new trend. If you're on the wrong side of a breakout, your small manageable loss can quickly turn into a significant one. That's why our stop loss is not just a suggestion, it's a hard and fast rule. Another risk is the fake out. This is when the price briefly breaks out of the range, only to reverse and come right back in. This can be incredibly frustrating, as it can trigger your stop loss just before the price moves in your favor. To avoid fakeouts, we look for confirmation. We don't just trade the breakout, we wait for the price to retest the broken level. For example, if the price breaks through the resistance, we wait for it to come back down and test that old resistance level, which should now act as a new support level. If it holds, then we can consider entering a trade in the direction of the breakout. Range trading is not a set it and forget it strategy. It requires active management, a keen eye for detail, and the discipline to stick to your rules. But for those willing to put in the work, it can be an incredibly effective way to generate consistent profits in a sideways market. It's about embracing the boredom, finding the rhythm in the chop, and playing the probabilities. It's the art of the crypto grind. Now, I know what some of you are thinking. Bonnie, that all sounds like a lot of work. I have a day job, a family, a life. I can't be glued to the charts all day. And you know what? I hear you. Not everyone is cut out to be an active trader, and that's perfectly fine. In fact, for many, a more passive approach is not only more practical, but also more profitable in the long run. So, for our passive investors, let's talk about the holy trinity of DeFi passive income: yield farming, liquidity provision, and staking. Let's start with yield farming. Imagine you have some money sitting in a traditional savings account, earning a measly 0.5% interest per year. Now, imagine you could take that money, put it into a decentralized savings account, and earn 5%, 10%, or even 20% per year. That, in a nutshell, is yield farming. You're essentially lending your crypto assets to a DeFi protocol, and in return, you're earning a yield. These protocols, like Aave, Compound, and Spark, are the new banks of the decentralized world. They connect lenders with borrowers, and they use smart contracts to automate the entire process. You can lend out your stablecoins like USDC or UTST and earn a relatively stable yield, currently ranging from 3% to 7% APY. Or you can lend out more volatile assets like Ethereum and earn a yield that fluctuates with the market. The beauty of yield farming is that it's completely permissionless. Anyone with an internet connection and a crypto wallet can participate. There are no banks, no middlemen, no gatekeepers. It's just you, your crypto, and the code. But, and this is a big but, with great power comes great responsibility. And in DeFi, with high yields come high risks. The biggest risk in yield farming is smart contract risk. These protocols are built on complex code, and if there's a bug or a vulnerability in that code, hackers can exploit it and drain the protocol of its funds. We've seen it happen time and time again. That's why it's crucial to only use reputable, audited protocols. Look for protocols that have been battle-tested, that have a strong community, and that have a bug bounty program in place. Another risk is impermanent loss. This is a concept that can be a little tricky to wrap your head around, but it's essential to understand if you're going to be a liquidity provider. Which brings us to our next topic, liquidity provision. Liquidity provision is the backbone of decentralized exchanges, or DEXs, like Uniswap and SushiSwap. Unlike centralized exchanges, which use a traditional order book to match buyers and sellers, DEXs use a system called an automated market maker, or AMM. And for an AMM to work, it needs a pool of assets to trade against. This is where liquidity providers, or LPs, come in. As an LP, you deposit a pair of assets, or say ETH and USDC, into a liquidity pool. In return, you receive a share of the trading fees generated by that pool. So every time someone trades ETH for USDC on that DEX, you get a small piece of the action. It's like being a toll booth operator on the crypto highway. The more traffic there is, the more tolls you collect. Sounds great, right? Passive income from trading fees? But here's the catch: impermanent loss. Let's say you deposit 1 ETH and 3,150 USDC into a liquidity pool. The total value of your deposit is $6,300. Now, let's say the price of ETH doubles to $6,300. In this scenario, arbitrage traders will come in and rebalance the pool. They will buy the cheaper ETH from the pool until the ratio of ETH to USDC reflects the new price. When you go to withdraw your funds, you might find that you have less ETH and more USDC than you started with. And if you had just held your original 1 ETH and 3,150 USDC, your portfolio would be worth more. That difference in value is impermanent loss. It's called impermanent because if the price of the assets returns to the original ratio, the loss disappears. But in a volatile market like crypto, that's a big if. Impermanent loss is a real risk and it can eat into your profits or even cause you to lose money. So before you jump into a liquidity pool, you need to do your homework. Understand the risks, choose your pairs wisely, and be prepared for the volatility. Finally, we have staking. This is perhaps the most straightforward of the passive income strategies. When you stake your crypto, you're essentially locking it up to help secure a proof of stake blockchain like Ethereum. In return for your service, you earn a reward, typically in the form of more of that same cryptocurrency. It's like earning interest on your savings account, but instead of a bank, you're helping to secure a decentralized network. The returns from staking are generally lower than from yield farming or liquidity provision, typically in the range of 2 to 7% APY, but the risks are also lower. The main risk is validator risk. If the validator you're staking with misbehaves or goes offline, you could lose a portion of your staked assets. That's why it's important to choose a reputable validator with a proven track record. So there you have it. The passive income trifecta: yield farming, liquidity provision, and staking. Each has its own unique risk and reward profile. Which one is right for you depends on your risk tolerance, your time horizon, and your overall investment goals. So we've covered the active strategy of range trading and the passive strategies of yield farming, liquidity provision, and staking. Now let's put them head to head in a classic bonus life showdown. Strategy: type, potential returns, risk level, time commitment, best for range trading, active 2 to 5% per trade, medium, high, sideways markets, yield farming, passive 5 to 20%, APY, high, low, DeFi enthusiasts, liquidity provision, passive, variable fees, high, low, long-term holders, staking, passive 2 to 7% APY, low, medium, very low, conservative investors. As you can see, there's no one-size-fits-all answer. If you're an active trader who enjoys the thrill of the chase and you have the time and discipline to manage your trades, then range trading is a fantastic strategy for the current market. You can grind out consistent profits while the rest of the market is waiting for a trend to emerge. If you're a more passive investor and you're comfortable with the risks of DeFi, then yield farming and liquidity provision can offer some very attractive returns. But you need to go in with your eyes wide open. Understand the risks of smart contract failure and impermanent loss. Do your own research and never invest more than you're willing to lose. And if you're a conservative investor who wants to earn a passive income on your crypto with minimal risk, then staking is a great option. The returns may not be as high as with other strategies, but it's a simple, straightforward way to put your crypto to work. Now, I want to bring in some outside voices. It's always good to get a range of perspectives, especially in a market as complex as this one. Some analysts, like those at Bitfinex, are suggesting that the sideways chop could continue for a while and that Bitcoin bulls might be losing their patience. This reinforces the idea that range trading could be a viable strategy for the foreseeable future. On the other hand, we have some experts who are calling this the easiest bear market ever. They argue that the market is following predictable patterns and that the current downturn is a healthy correction before the next leg up. This perspective might give some comfort to our long-term HO dealers. And what about the big institutions? Well, they're still here. While we have seen some outflows from Bitcoin ETFs recently, major players like BlackRock are still recommending a 1% allocation to Bitcoin for their clients. This is a huge vote of confidence in the long-term viability of the asset class. And we're also seeing a massive whale-level reshuffling of holdings, which suggests that the smart money is accumulating, not capitulating. So, what does this all mean for you? It means that you have options. It means that you don't have to be a victim of the bear market. You can be a participant, you can be a strategist, you can be a survivor. The crypto winter can be a daunting time. The fear, uncertainty, and doubt can be overwhelming. But it's in these moments of adversity that true character is forged. It's in these moments that the next generation of crypto millionaires are made. Whether you choose to be an active range trader, a passive yield farmer, or a steadfast staker, the key is to have a plan, to be intentional, to be disciplined, and to never stop learning. The crypto market is constantly evolving, and the strategies that work today might not work tomorrow. That's why it's so important to stay informed, to stay engaged, and to stay curious. And that's what we're all about here at Bonnie's Life. We're here to help you navigate this crazy, wonderful world of crypto, one block at a time. So if you found this video helpful, be sure to hit that like button, subscribe to the channel, and ring that notification bell so you never miss an episode. And as always, this is not financial advice. Do your own research and make the decisions that are right for you. Until next time, stay strong, stay smart, and stay savvy. This is Bonnie, signing off. Now, let's really dissect these numbers because they tell a fascinating story. That $1 trillion drop in market cap, that's not just a number. It's the evaporated euphoria of a bull market. It's the paper hands folding, the tourists going home, and the market cleansing itself of the irrational exuberance. But for us, it's a signal that the market is resetting, creating a more stable foundation for the next growth cycle. The liquidation data from CoinGlass is particularly revealing. Over 173,000 traders liquidated in a single 24-hour period. That's a city of traders getting wiped out. And the majority of them, over 74%, were long positions. This tells us that many traders were still betting on a quick recovery, a V-shaped bounce that never came. They were fighting the trend, and they paid the price. This is a powerful lesson for all of us. In a bear market, the path of least resistance is down, or sideways. Don't try to be a hero and catch a falling knife. The long-short ratio, currently at 48.27% to 51.73%, is another key indicator. It's a snapshot of the collective sentiment of the derivatives market. A ratio below 1 indicates that there are more short positions than long positions, meaning that more traders are betting on the price going down. While this might seem bearish on the surface, it can also be a contrarian indicator. When sentiment becomes too bearish, it can lead to a short squeeze, where a sudden price increase forces short sellers to buy back their positions, further fueling the rally. So, while we respect the bearish sentiment, we also keep an eye out for signs of extreme pessimism, as this can often precede a market reversal. And what about the whales, the large holders who can move the market with a single trade? The data suggests a massive whale-level reshuffling of holdings. This is not a mass exodus. It's a strategic repositioning. The smart money is not selling and running for the hills. They are accumulating, moving their assets, and preparing for the next market cycle. This is a sign of quiet confidence, a signal that the long-term outlook for crypto remains strong, even in the face of short-term volatility. So, when we look at the market data, we don't just see red numbers and scary headlines. We see a market in transition. We see a market that is punishing the reckless and rewarding the patient. We see a market that is setting the stage for the next chapter of crypto's incredible story. And we, as savvy investors, are here to read the signs and play our part. Let's get our hands dirty and walk through a hypothetical range trade on Bitcoin. Let's say we've identified a clear range for Bitcoin between $94,000 support and $98,000 resistance. The price has been bouncing between these two levels for the past few weeks like a ping-pong ball in a very expensive game. Step 1. Confirmation. The price is approaching our support level of $94,000. We don't just blindly place a buy order. We wait for confirmation. We pull up our charting software and look for a few key signals. First, we look at the candlestick patterns. Are we seeing a bullish engulfing pattern, a hammer, or a doji? These are all signs that the selling pressure is exhausting and the buyers are starting to step in. Next, we look at the volume. Is the volume increasing as the price approaches the support level? This is a good sign. It shows that there is strong buying interest at this level. If the volume is decreasing, it could be a sign that the support is weak and might not hold. Finally, we look at our indicators. The Relative Strength Index, RSI, is a great tool for identifying overbought and oversold conditions. As the price approaches our support level, we want to see the RSI in oversold territory below 30. This tells us that the asset is oversold and is due for a bounce. We can also look for bullish divergence, where the price is making a new low, but the RSI is making a higher low. This is a powerful signal that the downward momentum is fading. Step 2. Entry. Once we have our confirmation, we're ready to enter the trade. We place a buy order at or near the support level of $94,000. We're not trying to time the exact bottom, we're just trying to get in at a good price. Step 3. Stop loss. This is the most important step. We immediately set a stop loss order just below the support level, say at $93,500. This is our risk management. If the price breaks down through the support, our stop loss will automatically sell our position, limiting our loss to a small predefined amount. In this case, our risk is $500 per Bitcoin. Step 4. Target. Our target is the resistance level of $98,000. We can place a take profit order at this level, which will automatically sell our position when the price reaches our target. In this case, our potential profit is $4,000 per Bitcoin. Step 5. Management. Now, we let the trade play out, we monitor the price action, but we don't get emotional. We have our plan and we stick to it. If the price moves in our favor, we can consider moving our stop loss up to our entry point, making the trade risk-free. If the price stalls or reverses, we don't panic. We trust our analysis and our stop loss. The psychology of range trading is just as important as the technical analysis. It's a game of patience and discipline. You have to be comfortable with taking small profits and small losses. You have to be able to resist the temptation to chase breakouts or to get greedy and hold on for a bigger move. It's about being a sniper, not a machine gunner. You wait for the perfect shot, you take it, and then you wait for the next one. Let's delve deeper into the world of passive income, because this is where you can truly make your crypto work for you 24/7, even while you sleep. Yield farming strategies. Yield farming is not just about finding the protocol with the highest APY. It's about understanding the risks and rewards of different strategies. For example, you can use a stablecoin farming strategy where you only provide liquidity for stablecoin pairs like USDC/DAI. This significantly reduces your risk of impermanent loss. As the prices of the two assets are pegged to each other, the yields will be lower, but it's a much safer way to earn a passive income. Another strategy is liquidity mining, where you provide liquidity to a new protocol in exchange for their native token. This can be incredibly lucrative, as you're essentially getting in on the ground floor of a new project. However, it's also incredibly risky. The value of the native token can be highly volatile, and the protocol itself may be unaudited and vulnerable to hacks. This is a high-risk, high-reward strategy that is only suitable for experienced DeFi users. Mitigating impermanent loss. Impermanent loss is the silent killer of liquidity providers. But there are ways to mitigate it. One strategy is to provide liquidity for assets that have a high correlation. For example, providing liquidity for a WOBO BTC/BTC pool will have very little impermanent loss, as the prices of the two assets are essentially the same. Another strategy is to use protocols that offer impermanent loss protection. These protocols use a variety of mechanisms, such as insurance funds or single-sided liquidity provision, to protect LPs from impermanent loss. These protocols are becoming increasingly popular, and they are a great option for risk-averse liquidity providers. The staking spectrum. Staking is not a monolithic activity. There are different ways to stake your crypto, each with its own set of trade-offs. Solo staking. This is the most decentralized and pure form of staking. You run your own validator node, which requires a significant technical expertise and a large amount of capital, 32 ETH for Ethereum. In return, you earn the full staking reward. Staking as a service. If you don't have the technical skills or the capital to run your own validator, you can use a staking as a service provider. These companies run the validators for you, and you simply delegate your stake to them. In return, they take a small fee from your staking rewards. This is a much more accessible option for the average user. Liquid staking. This is the latest innovation in the staking world. With liquid staking, you can stake your crypto and receive a liquid staking token in return. This token represents your staked assets, and it can be traded, used as collateral in DeFi, or sold at any time. This solves the problem of illiquidity in traditional staking, where your assets are locked up for a period of time. Protocols like Lido and Rocket Pool are the leaders in the liquid staking space, and they are a great option for users who want to have their cake and eat it too. Earn staking rewards while maintaining the liquidity of their assets. Let's bring it all together with a more granular comparison of our strategies and some more pearls of wisdom from the crypto sages. Strategy, risk profile, return profile, technical skill, time commitment, capital requirement, range trading, medium, low medium, consistent, medium high, high, low high, yield farming, high, high, variable, medium, low high, liquidity provision, high, a medium, variable, medium, medium high, staking, solo, low, stable, high, staking, SAS, low, stable, low, high, liquid staking, low, stable, low, high. As you can see, the best strategy is highly dependent on your individual circumstances. There is no magic bullet. The key is to find the right balance of risk, return, and commitment that aligns with your goals. And what are the experts saying now? We're hearing a lot of talk about patience and discipline. Raoul Pal, a former Goldman Sachs executive and a respected voice in the crypto space, has been a vocal proponent of a long-term, macro-focused approach. He argues that the current bear market is a blip on the radar in the grand scheme of crypto's adoption curve. He advises investors to zoom out and focus on the long-term trend, rather than getting caught up in the short-term noise. Cathie Wood, the CEO of ARK Invest, is another prominent bull. Her firm has been a major investor in crypto, and she remains incredibly optimistic about the future of the asset class. She believes that we are still in the very early innings of the crypto revolution, and that the current downturn is a buying opportunity for long-term investors. Of course, not everyone is so bullish. Peter Schiff, a well-known gold bug and crypto skeptic, has been taking a victory lap during the current downturn. He argues that crypto is a bubble that is finally popping, and that investors should flee to the safety of gold. So, who should you believe? The bulls, the bears, or the gold bugs? The answer, as always, is to listen to all of them and then make up your own mind. Do your own research. Understand the arguments on both sides. And then, and only then, can you make an informed decision. So as we draw this deep dive to a close, what are the key takeaways? First, the bear market is not something to be feared. It's something to be understood. It's a time for strategy, for discipline, and for a healthy dose of intellectual curiosity. Second, you have options. Whether you're an active trader or a passive investor, there are strategies that you can use to not only survive, but thrive in the current market. And third, the long-term outlook for crypto remains incredibly bright. The institutions are here, the whales are accumulating, and the innovation is not slowing down. This is not the time to bury your head in the sand. This is the time to sharpen your skills, to expand your knowledge, and to position yourself for the next chapter of this incredible journey. The crypto winter will not last forever. Spring is coming, and when it does, you want to be ready. Thank you for joining me on this journey through the crypto winter. I hope you found it valuable. If you did, please consider subscribing to the channel and sharing this video with anyone who might be feeling a little lost in the current market. Together, we can navigate this winter and emerge stronger on the other side. Until next time, stay curious, stay informed, and stay profitable. This is Boni, signing off.